All right, the last learning objective in chapter 5 talks to you a little bit more um, about determining the sales that are required to get that targeted net income. And they also introduce you to something called a margin of safety. All right. So the first thing is target net income. Right. What's the level of sales necessary to achieve a certain profit? That's all important, right? And so again, lots of different ways to approach it. That mathematical equation, contribution margin technique, and another graph um, in that. And again, we're looking at how to express it either in units, which is sales units, or dollars, sales dollars, in order to reach a particular goal. So the mathematical equation, right? Your required sales minus your variable costs minus your fixed costs will get you to that target net income, whatever that target is. So let's say in this case, the target net income is $120,000. That's your profit. That's what you want your profit to be. So what do you have to do? What do you have to sell in terms of quantity to get a net profit of 120,000? Well, again, you start off with the mathematical formula: $500 times the quantity minus $300 times the quantity in variable costs minus $200,000 will get you the 120. Right? We're sort of swapping 200,000 goes on the other team. We got 200 Q, $200 times Q on one side, 320,000 on the other side, and so our Q will solve to be 1,600 in units. The number of units need to be sold in order to get that profit of $120,000. And that's what it says right here. You can also determine things by the contribution margin per unit. If you look at the fixed costs, add in the target net income, and divide that by the contribution margin per unit, you can also calculate the number of units you would need to sell in order to reach that level of profit. Okay. In order to do it in terms of dollars, right, sales dollars, how much sales dollars you would need in total, you can use the contribution margin ratio. In this case, we have fixed cost of 200,000 and a desired targeted profit of 120,000, so 320,000 in total, divided by the contribution margin ratio of 40%. Well, that would mean we would have to sell $800,000 worth of these units in order to accomplish that. More graphic stuff. A little shy about graphs. Okay, just being stupid. Margin of safety. Yes, margin of safety. So in essence, what we're looking at here is a margin of safety is really the difference between your actual or expected sales and the sales you would need to break even. Okay. Margin of safety is also considered a cushion. Okay. And it can be expressed in full by dollars, or you can actually express it as a ratio. So let's assume in this particular instance, your expected sales are 750,000. Your break-even sales are $500,000. So your margin of safety would simply be the difference between the two, 250,000. Okay. So this looks like very much like the same slide. Okay. So let's take a look at the do it exercise for this, because that's really all there is to this particular one. First, we're going to be looking at the Zoot Suit. And Zoot Suits makes travel bags that sell for 56 bucks. Okay. Management expects the fixed costs to be a whole 320,000. Variable costs to be $42 per unit. There's not much there here. Okay. Not much of a difference, right? Those variable costs are pretty high. So compute the following. Break even in terms of dollars, which we can do, no problem. The margin of safety and something called a margin of safety ratio, which is easy to calculate, assuming that sales are over 1.3 million. And part C is the sales dollars required to earn a profit of 410,000. Okay, so one at a time. Let's look at A first. All right. So compute the break-even point in dollars. So here we have the contribution margin ratio. We have $56, which is the revenue for each, minus $42, which is the variable cost for each. That'll give us $14 divided by $56 is a 25% contribution margin ratio. In terms of break even with dollars, you can take the fixed costs of 320,000 divided by the contribution ratio of 25%, and they would have to sell $1,280,000 worth of these travel bags to break even using that formula. Okay. So that's the first thing they wanted you to learn. The second thing is compute the margin of safety. That's relatively easy to do. And the margin of safety ratio, assuming your sales are 382,400. So you already know from the previous slide, your break even is 1,280,000. That's your break even. Here, they're telling you you sold 1,382,000. So in terms of the margin of safety in dollars, it's simply the difference between the two numbers. That's easy. Now, the ratio is simply that margin of safety divided by the original amount of sales. So basically, their margin of safety ratio is 7.4%, which is that $102,000 margin of safety divided into the sales. Okay. So that is something else that they're going to want you to do. And the last thing is, what would be the sales dollars required if this company wanted to have a pretty large profit of $410,000? Well, they would take the fixed costs of the company, which is the 320, add the profit that they want to earn of 410, and divide that by the 25% contribution ratio margin. They would need to sell almost $3 million worth of these travel bags in order to get that type of a net income. Okay, that's a lot of packing to do, for sure. So that's how chapter 5 ends. I'll take a moment for questions and comments.